Okay, so you want to own a cemetery. Rolling green acres behind a wrought iron gate, a business that sells the one product every single human being will eventually need, and a customer base that, structurally speaking, only grows every single year. You picture a quiet, dignified land empire, appreciating in value forever, selling small 6 by 3 foot parcels for thousands of dollars apiece, while the actual cost of that dirt stays essentially unchanged. Sounds simple. It is not simple. Here's what nobody tells you before you buy the land and start platting the lots. You are not actually building a business, you are building a countdown clock. Because every single acre you sell brings you one step closer to a day when your revenue stops completely while your legal obligations continue forever. And the largest cemetery operator in America once got caught by federal regulators borrowing against money it was legally required to leave untouched. So let us take apart what actually happens when you own a cemetery. Let us start with the number that defines everything else about this business: land. Raw land acquisition for cemetery development runs anywhere from a few $1,000s an acre in a rural market to well over $55 million for a large multi-site campus. And unlike almost any other property business on this channel, you cannot simply buy the cheapest available parcel because your zoning, your groundwater, and your soil composition all have to satisfy state regulators before a single grave can legally be dug. Once the land is secured, development costs stack up fast. Subdividing a plot into individual burial sections requires materials, labor, and heavy equipment that on a single small section can run in the range of $15,000 for grading, materials, and excavator rental alone. And that number multiplies quickly across dozens of sections on a full-sized property. Walkways, garden beds, drainage systems, and irrigation infrastructure all have to be engineered in before a single lot goes up for sale, because water pooling on a burial section is both a maintenance nightmare and a public relations disaster you cannot afford. But here is the invisible cost that separates a cemetery from every other real estate business we have covered: the Perpetual Care Trust. Most states legally require cemetery operators to deposit a fixed percentage of every single plot sale, typically somewhere between 5 and 20%, into a dedicated trust fund whose principal must remain untouched forever, with only the investment income allowed to fund future maintenance. This is not an optional savings account. It is a binding legal obligation baked directly into your capital structure from day one, which means a meaningful slice of every dollar you collect from a grieving family is immediately locked away and unavailable to you, the operator, no matter how tight your cash flow gets. Add construction of mausoleums and columbariums for above-ground interment, structures that can run into the millions depending on size and materials. Add a chapel or administration building. Add specialized security and surveillance, given how frequently cemeteries deal with vandalism and theft of bronze fixtures. And add licensing and permitting that in many states requires a full environmental review before groundbreaking. And you begin to understand why a cemetery, despite selling what looks like empty grass, requires capital commitments that rival a mid-sized commercial real estate project before a single plot has ever been sold. There is also a design decision that shapes your entire long-term revenue potential before you have sold anything: grave density. How tightly you can legally plat individual burial sites, how much space state regulations require between rows, and how much land you set aside for roads, walking paths, and ornamental landscaping all directly determine how many total plots your acreage can ever generate. A property that plats efficiently might yield noticeably more sellable inventory per acre than a competitor down the road who prioritized wide walkways and dramatic landscaping, which means two cemeteries built on identical parcels of land at identical cost per acre can end up with meaningfully different total lifetime revenue ceilings, baked in permanently the day the surveyor finishes the plat map. So the gates are open, the sections are platted, And now the daily grind of keeping this property immaculate begins. Because a cemetery carries one of the strangest fixed cost structures in all of commercial real estate. A building that never fills up in the traditional sense, but that must be maintained to a flawless standard on every single acre, sold or unsold, forever. This is operating leverage applied to grass and granite. Landscaping and groundskeeping run constantly. Mowing, trimming, tree care, and pathway maintenance across the entire property, regardless of how many burials happen that month. Because a family visiting a loved one's grave in an overgrown, poorly maintained section will not simply complain, they will actively steer every friend and relative away from ever buying a plot at your property again. Payroll for groundskeeping staff, administrative personnel, and licensed staff needed for internments ticks on a fixed schedule. And property taxes on every acre of unsold, undeveloped land keep accruing, whether that land generates a single dollar of revenue this year or not. Water and irrigation costs run relentlessly across acres of maintained lawn, and infrastructure like roads, drainage systems, and security lighting requires ongoing repair regardless of seasonal burial volume. Because unlike a retail store that can simply close on a slow Tuesday, a cemetery has to remain fully accessible, fully lit, and fully secured every single day of the year. One detailed financial model for a mid-sized cemetery development pegs total monthly fixed overhead, covering property taxes, land management, and professional services, at roughly $34,500, a number that keeps ticking whether the property books 3 burials that month or 30. None of these costs care about your sales calendar. The mowers still run, the pathways still need clearing after every storm, the property tax bill still arrives, and the Perpetual Care Trust obligation continues accruing against every single plot you have already sold, regardless of how quiet the phones have been. Insurance adds a layer most outsiders never consider, because a cemetery carries a unique liability profile. Families visiting at all hours, heavy equipment operating near occupied graves, and monuments that can shift or topple over decades of freeze and thaw cycles, all of which require coverage most standard commercial policies were never designed to handle. And unlike a business that can simply shut its doors during a renovation, a cemetery has to keep every previously sold section fully accessible during any construction or expansion project happening elsewhere on the property, which means simultaneous active maintenance and active development become a permanent operating condition, rather than a temporary phase, adding coordination costs that never fully disappear as long as the property keeps growing. So how does anyone actually turn a profit selling small parcels of dirt against costs this relentless? This is the popcorn business moment. And in cemetery economics, it hides in the difference between what a family expects to pay and what they actually end up spending. The base ground burial plot itself, priced somewhere between $1,000 in a public cemetery and $15,000 or more in a premium private memorial park, functions almost like a loss leader once you account for the perpetual care contribution, the property tax burden, and the development cost already sunk into that section, because the plot price alone barely clears the true cost of maintaining that 6 by 3 foot parcel forever. The real profit machine sits in everything layered on top of that base price. Opening and closing fees for actually digging and filling the grave run $1,000 to $3,000. Burial vaults required by most cemeteries to prevent ground settling run $1,200 to $3,500. And headstones and monuments run anywhere from $500 for a basic flat marker to $8,000 or more for an elaborate upright design. And industry data shows opening and closing fees alone can effectively double the total cost a family ends up paying beyond the advertised plot price. Here is where the discovery pricing mechanism from our other episodes shows up again in an even more powerful form: mausoleum crypts and above-ground interment. A ground plot is a known value item. Families can compare prices across cemeteries in their area, which caps how aggressively you can mark it up. But a mausoleum crypt or a private family estate, priced anywhere from $7,000 to $20,000 or more per space, has almost no comparable reference point for a grieving family making this decision for the first and only time in their life. Why would a family accept that markup without blinking? Because the emotional framing around a mausoleum, permanence, prestige, protection from the elements, removes the analytical, comparison shopping instinct that would normally cap a price. The same psychological mechanism that lets a golf course sell real estate around its fairways, or a casino comp a high roller's suite. And underneath all of it sits pre-need. Families purchasing plots and services years or decades in advance, locking in a sale today against a service that will not actually be delivered for a generation, giving the operator a growing pipeline of contractually guaranteed future revenue, sitting on the books well before the corresponding cost is ever incurred. Cremation niches represent a newer, quietly efficient piece of this same profit engine. Small columbarium spaces holding an urn instead of a full casket, priced anywhere from $500 to $3,000, but requiring a tiny fraction of the land, excavation, and vault infrastructure a traditional ground plot demands. As cremation rates climb nationally, the smartest operators have learned to treat niche space almost like a second, higher-density product line layered on top of their traditional ground inventory, extracting meaningfully more total revenue per square foot of columbarium wall than the same square footage could ever generate as a traditional lawn section, all while requiring a fraction of the ongoing groundskeeping burden a full burial section demands. Now here is the trapdoor under the floor, and unlike almost every other business on this channel, this one is not a market risk or a regulatory risk. It is baked directly into the physics of the product itself. Finite inventory colliding with an infinite obligation. A cemetery has a hard ceiling on how much land it can ever sell. Once every plotted section is occupied, the core revenue engine of the entire business simply stops, permanently, with no possibility of restocking the shelves the way almost every other retail business can. But the perpetual care obligation attached to every single plot you already sold does not stop when your inventory runs out. It continues indefinitely, funded entirely by the investment income generated from a trust you were required to fund years or decades earlier, which means the entire long-term solvency of your business depends on correctly estimating, decades in advance, how much trust income a finite pool of capital will need to generate to cover maintenance costs that will only grow more expensive with time. Get that calculation wrong, underfund the trust during your active selling years, or simply mismanage the trust's investment returns, and you create a mathematical trap no amount of good groundskeeping can fix later, because you cannot go back and sell plots that have already been occupied for 50 years to raise emergency maintenance cash. This is a risk almost entirely of the operator's own making decades earlier, discovered only when the sales revenue has already dried up and the maintenance bills keep arriving anyway. Which is precisely why regulators in most states treat perpetual care trust funds with the same seriousness as a pension fund. Because in a very real sense, that is exactly what they are. There is a second, quieter version of this same trap tied directly to the cremation trend we have discussed elsewhere on this channel. As more families choose cremation over traditional burial, demand for full-sized ground plots softens, even as cemeteries still hold decades of previously platted burial inventory sitting unsold. Which means the revenue timeline that was originally projected to fund a fully stocked perpetual care trust can stretch out far longer than planned, leaving less time and fewer sales to build the reserve that eventually has to fund maintenance in perpetuity. A cemetery planned assuming steady burial demand for the next 30 years, only to watch cremation preference accelerate faster than expected, can find its entire long-term funding math quietly falling out of alignment with reality, years before anyone notices the gap. Let us talk about Stonemore Partners, once the second-largest cemetery and funeral home operator in the United States, running 316 cemeteries and 100 funeral homes across 27 states and Puerto Rico. As a publicly traded partnership, Stonemore faced constant pressure to show growing distributable cash to investors every single quarter. But the accounting reality of cemetery sales worked directly against that pressure, because state law required a meaningful share of every plot sale to flow immediately into a locked perpetual care trust rather than count as spendable current revenue. Rather than accept the slower, honest growth that structure implies, Stonemore did something regulators would later describe in stark terms: borrowing cash to fund investor distributions in the very same quarters that pre-need sales were being booked, then using proceeds from new equity offerings to pay down that borrowed cash, creating a rolling structure entirely dependent on continuously raising fresh outside capital just to paper over an underlying cash shortfall building beneath the surface. In 2016, Stonemore announced it would restate roughly 3 years of previously reported financial statements. The Securities and Exchange Commission ultimately charged Stonemore and its general partner in December 2019 for failing to disclose material liquidity problems, finding that internal sales metrics had shown the company missing its own sales budgets by as much as 15% for multiple consecutive quarters, without that material risk ever appearing in official filings. Stonemore became delinquent on required regulatory filings and faced the real threat of delisting from the New York Stock Exchange, while limited partners absorbed years of restated numbers and legal uncertainty as the company worked through its structural cash crisis. And the underlying temptation never fully disappeared, even after the reorganization. Years later, under its renamed successor Everstory, Tennessee's Department of Commerce and Insurance fined the company $40,000 after discovering that money collected specifically for pre-need perpetual care trust funds had instead been directed into an unrelated shoe company investment tied to a company executive, a direct violation of exactly the trust laws those funds exist to enforce. The lesson is not that cemetery ownership is inherently fraudulent. The lesson is that a locked trust fund sitting next to a business under constant pressure to show growth creates a persistent temptation that broke discipline, even at the largest, most sophisticated operator the industry has ever produced. Let us run the numbers on a mid-sized private cemetery with roughly 40 acres of developable land, optimistic scenario against realistic bad year. In the optimistic scenario, your section development is efficient, keeping cost per plot low relative to your average sale price. Your product mix includes a healthy share of higher-margin mausoleum crypts alongside standard ground burial, and your perpetual care trust is fully funded and generating investment returns that comfortably outpace your actual maintenance cost inflation. On a property generating steady annual plot and merchandise sales, disciplined cost management can produce net profit margins in the 20 to 30% range once initial development costs are behind you. And against an initial land and development investment in the multi-million-dollar range, a well-run property can reach payback within roughly 8 to 12 years of consistent sales. Now the realistic bad year. Regional population growth slows, or a new competing memorial park opens nearby, offering more aggressive pre-need financing terms, and your plot sales volume drops meaningfully below your original development projections, stretching your payback timeline further into the future. At the same time, a multi-year drought spikes your irrigation costs across acres of maintained lawn, precisely when your revenue is already softening. And rising property tax assessments on your remaining undeveloped acreage continue accruing regardless of how few sales you booked that quarter. Your fixed costs, the groundskeeping payroll, the security infrastructure, the ongoing trust contribution obligation on every previously sold plot, do not move by a single dollar in response to any of this. Net profit margin can compress from that comfortable 20 to 30% range down into the high single digits. And in a genuinely difficult multi-year stretch involving both slower sales and rising maintenance costs, a property can find itself in the exact structural bind Stonemore eventually faced. Revenue slowing while a perpetual, non-negotiable obligation keeps compounding in the background. The difference between these two scenarios on a mid-sized property can easily exceed several $100,000 in a single year. And for an owner who financed the original land acquisition and development with meaningful debt, that swing is exactly the kind of gap that turns a comfortable debt service coverage ratio into a very uncomfortable conversation with a lender who understands, just as clearly as you do, that this business cannot simply order more inventory when the shelves run empty. So what is a cemetery, once you strip away the wrought iron gates and the manicured lawns? It is a machine that turns a one-time sale of finite land into a permanent, compounding obligation to maintain that land forever, funded entirely by a trust you were legally required to build correctly decades before the bill ever comes due. Unlike almost every other business on this channel, you cannot simply work harder, market smarter, or cut costs your way out of a miscalculation made years earlier. Because the land you already sold is gone, the families who bought it expect flawless care and perpetuity, and the only lever left to pull is a trust fund whose investment performance was locked in long before today's maintenance bill ever arrived. You are not really buying acres of peaceful green lawn. You are buying a bet that you correctly priced an infinite promise using finite land, decades before you will ever find out whether that math actually worked.